We've got Dr. Surjit Bhalla with us, we've got Dr. Arvind Virmani with us, Sugata Bhattacharya of Axis Bank, and also we've got Ashish Parthasarathy from HDFC Bank. So we'll get the economic, the money market side all completely covered. Dr. Bhalla, I've got to start with you. What's your reaction, sir, just to the actions, but also what you heard in the policy? How much room do you suspect we have in this down leg of the rate cycle?
You know, covering Dr. Subbarao's if you will, monetary policy over the last 3 years has been very, very difficult, last 4 years, 5 years. And the reason it's been difficult is because, you know, he changes goalposts, he changes direction, and if you will, at least from my vantage point, there are inherent contradictions in his statement. Now, overall, I think what would I have done? As you know, I've been saying we should be cutting rates a long, long time back. And this time he's rather reluctantly given a bone and cut repo rate by 25 basis points. I think at a minimum he should have cut the repo rate by 50 basis points, because that is a much more important and potent message, if you will, to revive investment. He kept talking about we need investment and, you know, failed to mention that investment is also guided to a very large extent by interest rates. We've already had, he can't have the notion of policy paralysis anymore, which is where he hid under for the last 3 years. There is no more policy paralysis, at least according to most observers. Maybe according to the RBI there still is. So I'm more than a bit disappointed. You know, this is, and lastly, and then we can leave it open. Lastly, on the exchange rate, that a cardinal principle of central banking, certainly over the last 5 to 10 years, is that interest rates, lower interest rates, revive growth and help the exchange rate. So in other words, if you want your exchange rate to appreciate, you should, if you will, cut rates and enhance growth. This way we'll pay, you know, if you will, the exchange rate will not appreciate that much. So I think, you know, whether it's on the exchange rate side, whether it's on the investment side, you know, or on revival of, if you will, growth in the economy, and he kept stressing that that's your #1 objective, I think, you know, he hasn't done his part. The RBI has certainly not done its part. And I guess it's all left to the center and animal spirits to try and get investment going and growth going.
You know, I'll come to some of those debates, Dr. Bhalla, in a minute. I want to get reactions from everybody before we get into the debates, but I just want to add the, you know, the sort of the next factor that's playing out here. And Dr. Virmani, you know, yesterday's document was so hawkish sounding on the current account deficit, and it very clearly stated that is going to be an impediment on how much you can do in terms of monetary policy easing. You can't afford to boost aggregate demand when you're running a 5% plus CAD. All of that happened in the document yesterday. Today, yes, you talk about twin deficit risk, you talk about external vulnerability, but it's not reflecting in the policy actions. So I mean, there's some sort of disconnect. I mean, you know, whether you want rates to be cut or not is not the point, but there's a disconnect and changing goalposts, as Dr. Bhalla was saying.
Well, as I was saying just before the policy came through, I think that was more of an indirect signal. I agree that there doesn't seem to be a direct relationship, but the way I read it, you know, central banks talk in their own language, and the language that I understood was that is more a kind of warning that don't expect too much, which is why I said that the best I would expect from this policy was about 25 basis point cut as happened. So you're right about that. There is, of course, an analysis behind the current account deficit, which is in my view, you know, the CAD is more related to the fiscal deficit under the current conditions, just as it was in 91 at the time of the BOP crisis, and much less to the other end of the scale where people keep talking about gold imports, etc. Of course, everything is related to everything in macroeconomics, but in my view, once the fiscal deficit is under control, and in particular the expenditure side of the deficit is controlled, we will see an improvement in the current account deficit. So I see that as the same problem, more or less.
Okay, and if you're making some progress on the fiscal side, that should reflect. Saugata, let me come to you on what you think lies ahead. 25 basis in line with the projections. The CRR cut adds a bit of liquidity, so may allow the transmission mechanism to be a bit quicker. But what lies ahead? 50 basis points more than that?
Probably more than that. I mean, if the trajectory that we are seeing now in terms of fiscal consolidation, in terms of the appreciating rupee, however, that's the thing, that with the appreciating rupee, as we probably all of us expect, that changes the dynamics of the current account once again. But with the supply constraints easing up, probably exports are likely to do a little bit better than what they have done. But the current account deficit remains a key problem area. But even be that as it may, I think we should be seeing about a 75 to 125, depending on, I mean in total, coming in from here. So 75 to 125, with my sense now that rate cuts will probably be a little deeper than we had earlier expected.
Ashish, what do you think is going to be the response from a market standpoint, but also from a banking standpoint? I mean, keeping the liquidity conditions in mind, and I'm just going to mention that 2 large banks actually raised deposit rates going into this policy. So that stickiness on the deposit side, the ability of cost of funds to come down is still a question mark. Keeping those factors in mind, how do you see this playing out?
I think, Reserve Bank has mentioned in its review that monetary supply or M3 growth has been lower than what would have been ideal for this economy. Similarly, deposit growth has also been on the lower side. What we have been saying is, primary cause of that is low growth in the primary money supply, because we've seen Reserve Bank intervening the market. Dollar reserves have gone down. So there is need to improve primary liquidity, and that's what has been attempted by reducing CRR over this easing cycle, and this has another step. So at this point in time, I would say deposit rates will remain stable, unlikely to see a fall in deposit rates till we see deposit growth rates improving.
Ashish, just a quick word also on the bond markets. I believe yields have not reacted at all, but the currency is seeing this positively. I guess this is more or less in line with the worked itself out of the system. So from a market standpoint, this is a non-disruptive policy one way or the other?
Yeah, at this point in time, it seems to be like that. But if you look at the bond markets, if we continue to see fiscal consolidation and reduced money supply, I think you will see some lower yields, going in the next, I would say, 2 odd months.
India's #1 news app just got even better. Download NDTV's new app, fully optimized for Retina display, full screen view, faster response time, and Sudoku. NDTV's new iPad app. Download now.